While lawmakers are debating the effects of capping our country's carbon emissions, today the Senate Energy and Natural Resources Committee discussed the trading aspects of the proposed cap-and-trade plan. One of the sticking points here, how exactly to do that. Establish a carbon trading market without creating runaway prices for those particular carbon credits. Clean Sky's Dan Goldstein is just now back from this afternoon's hearing, and he joins us live. Dan, we're still waiting for the Senate climate bill here, but let's start off by talking about the kind of carbon market rules that the House version, Waxman-Markey, would establish on this topic.
That's right, Tyler. And one of the things that they are looking at is what's called a price collar. Now, obviously, we've talked a lot about emissions and capping, and this is really the part of the side that we're talking about, which is the trade side of cap and trade. And what they're looking at was called a price collar. Now, that sounds like a discount grocery store, which I used to shop at when I was an intern. But really what that's really about is what they want to do is have a defined trading range for these for these contracts. And right now, Waxman-Markey has a $10 per ton floor and a 28 per ton ceiling. And the concern is that basically is not the floor so much, but the ceiling, and that they're thinking that if by 2015, if the Waxman-Markey bill projects that carbon might be priced anywhere from $13 to $15, if traders see that $28 target, they might immediately run and grab it. And you can't help but thinking that, remember when Henry Blodgett back in the day of Merrill Lynch predicted a $200 to $300 target for then the internet stock Yahoo, that's immediately where that stock went. And that's very much his concern to a lot of these senators. They would like to see some kind of restraint on this price collar, as it were, to bring down that range and to make the trading a little less volatile.
Dan, the complaints about the cap are pretty clear. That is the cost overall. But the complaints about the trade seem to be a little narrower here. Some senators have concerns that a potential carbon market may face the same pitfalls that we saw in California 10 years ago with the power issues there, right?
Exactly, and one of the things they want to do is avoid that when prices get too high. If they get to that $28 number, what they want to do is basically, instead of raising that cap, just issue more permits. But the California issue is very much in people's minds. And you recall in 1999 and 2000, California deregulated its power market, its electricity market, and they saw runaway prices for electricity. Now, obviously, this is not deregulation. This is actually kind of a new regulatory step, but it is putting an entirely new trading regime on the books, and they're very concerned about what that exactly is going to mean. So the California experiment, as it were, is very much in their minds, and obviously they don't want to be voting for something that's going to lead to something like that.
One of the main issues we heard last summer, Dan, with skyrocketing oil prices was the issue of potential excessive speculation in the oil markets. Sounds like that any carbon market that's established could be susceptible to something similar, right?
Right, and that's another concern. And there's a lot of things that they're worrying about. Like we said, we were all talking about the California problem. They're talking about this price collar problem. And the next one that they're going to have to deal with, and this is something that I talked to several staffers about, is they're going to have to look at exactly when this regime gets going forward, not only who's going to be doing the trading and who gets to do what, because you've got really three levels. You've got people who need to buy and sell these commercially. Those are obviously going to be the power plants, et cetera. And then you've got the non-commercial traders, which we saw last year. The non-commercial traders were things like mutual funds and hedge funds for oil contracts, and then you've got the pure speculators. And the thing is that, Tyler, is that we all know is that you can't just limit the market to just the commercials. You need those non-commercials in there for liquidity. So that's something they're going to have to look at, is just to see who's going to get these contracts. But obviously, they don't want the situation where they had last year, where we saw runaway speculation, at least on the view of the Democrats, on oil contracts. And they certainly don't want runaway speculation when it comes to these carbon contracts as well.
Today, the first of two hearings from the Senate Energy Committee. Dan Goldstein, thank you very much for updating us there.